Support and resistance study, Google daily time frame, that spans over 8 months. So we gap up here, which is strength. Okay, then we drive up. As we drive up, support will be drawn. Okay, then as we react, as we come down from here, resistance would be drawn. Nothing more to it. Literally, we draw horizontal lines from the swing highs, legs or lows. Okay, now there is a little nuance here. Right. This first bar, I've drawn in my support, my resistance level here. Okay, why? Now this is a little nuance. When price contains itself, okay, well, what do I mean by this? You see the high of this bar, and then the no other bar is able to really penetrate over, or was not able to close over. This is a little ledge. Okay, so I would draw my resistance level from here. Most traders, or most other support and resistance applicators, would draw their resistance level from the high of that bar. But this bar here, where I draw it from, contains price, and therefore I think it's valid. Okay, now although this is very, it may seem pedantic and very subtle nuance, it does make a difference in your trading. Now, in this example, we can see if we put it here, okay, this level doesn't respect that resistance. Okay, but either or, but these are advanced uses. So we have support. As it rallies, we draw. As we come down here, as we react, this will be drawn. Okay, then we have support down here. So now we have a working support and resistance level. Okay, and we would expect this level to hold. We'd expect this drive up for this resistance to hold, and indeed it does hold. Okay, and if we were to up thrust here, come up, reverse, break that high and close low, that would be an excellent trade, but this doesn't occur. Now, as we come back down, there is a subtlety at play. We hold a higher level of support, which are the 3 purple highlights. This illustrates this nicely. So why is this additional strength? Well, the main support is here. Okay, and where price is unable to test the main support. So what does that mean? Well, it either means that the selling pressure is weak, or demand is aggressive. The buys are aggressive. So both are signs of strength. And this reminds me of we can go on to a good point, another valid point here. When this is a valid working trading range here. Okay, we've got two support levels, 2 resistance levels. Notice how price, we move up, we move down, and we move up and we move down, and there's equal distance. There's equal distance between the let's call these anchor points. There's equal distance between the anchor points. Okay, so from this support we rally up, we draw this in, and as we come back down we draw this in. So as we come back down to here, we spring. Okay, so that is a potential trade. Our first target would be here. Okay, because that's our first resistance level. Now, if you're some traders only trade short setups. They prefer to be sellers. Now, if this bar here went up and came back down, which we call an up thrust, as it rejects higher prices from here, as we have nice equal distance between our anchor points, good solid price action, as we rally up and we test and reverse, this would be a short play that we could make. Okay, because of the way that the price action and structure has unfolded, it gives us a license for a trade. Now this leads on to a valid point. So we've said that demand has entered earlier, as this was our main support. Now this is validated support and resistance. As we come up, we come down, we come up again. So when we come back down, we would expect this to hold. So why is this validated? Well, it's the key really are the anchor points. So this we'd call an anchor point. This is a support anchor point. This is a resistance anchor point, and this is a resistance anchor point. And what we want to see in an ideal world is time. It's white space distance between anchor points. Think this is a daily time frame. Each bar represents a day. And if we look here, this is May to July. So this is 2 months between the anchor points. This gives the support level validity. Okay, so when we hold a higher level of support above our valid demand support line where demand should enter, this is an incredible sign of strength. Well, let's make sure this concept is understood thoroughly. Firstly, try to think of anchor points to be load bearing. Okay, so let's call this S1 and this S2. Anchor point S1 and S2, and the load is all this price that is held from May to July. So that's 2 months worth. Okay. Now, what we don't want to see are the anchor points close together. So let's draw a new anchor point in much closer. So we've got S1 and this is S2. This will be our anchor point. And we'll just call this S3 and S4. Now, so S3 is no longer here. Okay, so rally from 1, come back down, test at S2, and we continue north to resistance. Okay, we would draw the support line as normal. However, the load, as in the price bars, is only 9 or 10 bars. Okay, so how can I put this? So our support S1, S2 here is not as strong as our original S1, S3. S1, S3 here contains all this price. This S1, S2 only contains these 9 or 10 bars. Now, bear that in mind. So our new anchor point here, we come up, come down, we test. Now, when we come back to react, we come back down, okay, and we visit the lows where we hold a higher level of support here, here, and here. It's much harder to interpret the strength, as there is no genuine validated support level, as there was from S1 to S3. So apologies, this is I've got a little bit of a tangent here, but just review this information. Okay, so S1 here and S2 has a much higher odds of success to hold from the pullback, okay, from the highs, much more than if S1 and new S2 were at support level. So let's just put this new anchor point here. So we come, suppose we go back up. Okay, so as we're coming down, yeah, this level here, this level of support has less high odds of success to hold on the reaction than we would do if we're coming down from here, because this would be our third touch and this would be our third touch. Okay, Now, in addition, if we were to have our second resistance anchor point closer and we upthrust, we talk about an upthrust here and we could take the position, okay, it's much more difficult to initiate a short play, okay, well, because if we have this little mini one here, and we have, so this one's gone, so we call this one R2, okay, we rally up, come down, push up, come down, and then we push here, and then we print an upthrust. It's just very difficult to take, you know. We have a big strong wave of buying up, and we have this little mild reaction here. It's very difficult to initiate a short play. Now, so even though both scenarios have 4 anchor points, the distance or the white space between the anchor points adds validity. You know, it has more load bearing capability. Also try to consider the time factor. You know, it gives an opportunity from this S1 and S2. You know, this is 2 months. Okay, this gives time for the market to digest. You know, it can accumulate or distribute, or of course, the controversial subject of support and resistance having a self-fulfilling prophecy element to them. It gives the market time to see this level. You know, as we push up here and we come down, you know, it gives us opportunity to see this level. Therefore, you know, this is the natural level of support. You know, as we're coming down, this would be a natural level for the market to find demand. So does it have does it have an element of self-fulfilling prophecy? You know, of course, I think it does. You know, it enables traders, you know, support and resistance traders and other traders to jump on board. Now, if we use the anchor close together, as in here, and then we come back down, it's just very hard to decipher. You know, why? It's because this support hasn't proven itself here. Although we hold, this hasn't proven itself. You know, this is the third touch, so this is the third trying to come down to touch here after all this time has passed. 2 months worth of trading, this has been validated. You know, let me just try and think of this. Support has proven itself. It's been validated. And also, when we have there's also an aesthetic way of looking at support and resistance. If we draw, say we've got this coming in here, we come down, it looks top heavy. You know, it looks unstable. The load bearing capability, think about it, we've only got 9 bars here, yet we rallied another 10-13 bars. It feels out of sync. I know this sounds very ambiguous, but you know, look at the price action. From here we push up, we react, we push up, we react, and look how price rallies. We rally and react in an orderly manner, you know, in an uptrend. For all intents and purposes, a healthy rally is 45 degrees. Okay? Anything over, so if the rally ascent is steep, greater than 45 degrees, the move is prone to be parabolic, which means it's rising too fast, too soon. You know, the buying is unsustainable. And conversely, if the angle of ascent is less than 45 degrees, the buying quality is suspect. You know, we're kind of grinding up. So, and also vice versa for a downtrend. So the anchor points close together, we don't really gain an edge. It's more difficult to interpret what the market is whispering. Now, in a nutshell, all we want to see is a decent amount of white space between the anchor points, regardless of the time frame used, whether it's a minute, 60-minute, 30-minute, hourly, weekly, monthly. Okay, and then just after time, you'll visually know. It'll have that aesthetic feel. Okay. Apologies for the tangent there. Let's carry on. Oh, before we do, please don't concern yourselves. I've mentioned springs and upthrusts. Don't concern yourselves as yet. We will study these in depth later, but a spring is when we dip but support, reverse to close firm. It's like a price rejection. And an upthrust is an opposite of a spring, where we break into new highs, reject, come down and close under. Okay, that's all they are. So from resistance we react down, and the first thing we notice is that the first purple box here holds. Okay, it holds above the previous low and support. It holds above here, and like we said, our valid support level. Okay, it rallies back up, comes back down, and holds again. Now I'm thinking, okay, as this bar closes here, this is when I would draw in this level. Okay, and I would also draw resistance from this little swing high. So I put that across there, and this. So we draw, as this bar closes here, I would draw this level here, and this little nuance here, this little bar here is a mini swing high. Okay, and I'll draw that in. Now, this is a subtle nuance and very powerful. Why? Because we're holding a higher level of support. As previously stated, demand buying should be coming in here. Yet we're holding here and here, which are two higher levels of support. Okay, although very subtle and may only be 5 points for this time frame. Don't forget this is a daily time frame, so let's have about 900, about say 5 points for this time frame. We are holding a higher level of support. That's the key. Buyers are eager, they're coming into the market earlier, they're ready, they're not willing to wait. This is important data. We now know that this trading range, our level of support and resistance, so this is our resistance and support, this is our trading range, okay, now has a bullish bias, and that's very important data. Anyway, so we come back down here, and what do we know? This bar here doesn't even manage to hold or test the lows here. We hold a higher level still, and the price action is strong. Look, it's a strong bar closing firm. Look at this down bar, and this down bar. Now look at this buying coming. So now we've got 3 areas of demand coming in earlier than it should do. This is strength, and this is very powerful data. Now we rally back up. As we do, we have rising lows, we form a little mini apex, and we think we're going to break to the upside, but we don't. We come back down. Now as we come back down and we rally up, I would probably draw this level in, okay, because we're unable to test. But as this comes back down and closes, therefore we know that this we would call a local level of support. And they're very, very powerful ways to get involved if you're trading intraday conditions, or if you like to trade trading ranges. These offer additional. This mini trading range that holds a higher level of support is strength. Holding this local level of support within the mini trading range is additional strength. And we can also see, again, note the buying. Okay, this dips under the lows here to reverse and close firm. Okay, this is the best buying that we've had for a while. So when this bar reverses and closes firm, we need to take into consideration the background conditions. We're holding a higher level of support as in the structure here, as said, the local level, additional strength, okay? And also the reactions are weaker in comparison. Selling from here, you know, overt selling, widespread bars, selling come down here, we get some decent selling, but not as strong as this. And then here, as we try to come down, buying off the lows, close off the lows, buying, closes. We can't, you know, so the selling quality has diminished while there's evidence of some fairly good buying. That's a good, strong wave up, okay? And there is also a subtlety where we even gap up here, you know, close firm, close firm. Now, so when this bar closes, we have enough story or the background conditions, we can buy this bar. Now, we have enough reasons to, or alternatively, we wait for a break of the trading range here, or most importantly, this level here. And look at this bar. Look how it pushes up, drives through, widespread. Now, don't forget that this mini trading range resistance has held for 2 months, and we're breaking through resistance above this price action here, and we close above. You know, this is strength coming into the market with our background of strength, and this all stems from holding a higher level of support. And by being able to read the subtleties, you know, by being able to read this is the key to the chart and why it's being used for the study. Now, let me just mention local level support again. We will have lots of studies, but here this is also a local level of support, okay, within, you know, the major trading range, which is this resistance and this support. Now, this local level would not be drawn until this bar, the third bar. This bar has been printed, which we say, bear with me. So that we draw in after this bar has closed, and that is what we would call a local level of support. Now, this is not a local level. This is a mini trading range, and its very nature is to pump up and down. You know, the nature is to gain contracts. You know, that's why we have trading ranges. It's either a breather from the buying or the selling. You know, we're either accumulating or distributing. Okay, we'll go into that further as well in another session. But local levels of support, this and this here, are that they're just supports, or mini supports, or mini shells that are formed within trading ranges, and they're important as they give you a way to jump on board and move within a larger time frame. Okay. So from our local level support, we rally back to resistance. Naturally, we should encounter some supply, but there's a big difference. What's occurring here? Last time was resistance here, good selling. Resistance here, we gap down. Now we come to resistance and we're holding. Okay, interesting. Now as we come back down, what happens? We hold. And if we draw this in here, look at that. We have a wonderful level of support. Isn't this fascinating? And then look, we gap up over resistance. Now we draw this level in here, and we draw resist as we push up. After a few days, we would draw resistance level here, and we draw support. Price has been contained. We come up, we up thrust here, we come back down, and then we spring on top of support. This action here is a spring. We spring this level of support on top of major support. That's a very high odds trade. Then as we rally, we break through into new highs. Now what do we notice? What's very important? We are in a wonderful uptrend. We are making higher highs. Excuse the writing. We're making higher highs all along whilst making lower lows. Okay, that's the very definition of a uptrend. High highs and lower lows, and we've been making lower lows. Look, here to here to here to here to here to here to here. So as we push up from here, as we spring here, we push up into new highs. Okay, we react back down to newly formed support, and look how it holds. Look at this price action, very narrow spreads, closing weak. Compare this to the buying here, good solid buying. Okay, good wave up, and look at the response. Look at that buying. You know, some may say that's parabolic, but given the context of we're in an uptrend, and you know, we're not in an overbought position. You know, we could draw a trend channel. So the support and resistance study from this daily chart is wonderful. I mean, it really, that support and resistance really is wonderful. I don't understand how some people do not use support and resistance levels. I mean, these work time and time again. I have spent thousands and thousands of hours trading using structure, using support and resistance. You know, there are subtleties. It does take practice and a bit of time, but by the end of today you will have all the tools, like I previously said. Excellent. So this concludes this study. Now let's go through some questions. Okay, so if you bought the local level of support, where would your stop be? Okay, so if I bought this, you mean? No, your catastrophic stop would have to be underneath this low. Okay. Alternatively, you could put it under the support or under the local level, this additional level of support. However, it's so close together. I mean, the best stop on this chart for this, if you're long here, is under here. You know, this is our major line in the sand. If we rally up and come back, if we rally here and then we come back down and we close here, you know, odds favour continuation and we break. So our analysis is incorrect. Okay, good question. Okay, another question. Why do I not use the open or candlesticks? Okay, good question. One that does get asked a lot. That is, I do go into depth later on in the course as to why, but for now, I find the most important information is the close. Okay, each bar represents a battle between buyers and sellers, and the close is the result. So take this bar here, okay, this bar here. I can see it's a down bar that closes on its lows, so I know that the sellers have won the bar. I don't really need to know the open. Okay, if it opens here, or you know, or here, it just doesn't help my analysis. You know, I want to keep things simple. I don't want to be thinking about opens. But of course, there's nothing wrong with using opens. You can use candlesticks if you desire. It's just mere personal preference. I mean, don't get me wrong. I too started with candlesticks. I think Steve Neeson went over to Japan and he introduced candlesticks to the West. And you know, you get the open, the close, the towels, the green for up, the red for down, and it was, you know, your mind, or my mind, tended to gravitate towards patterns rather than extracting the important data of who won the battle, bulls or the bears. I don't need a full story. Not a story, but I don't need all that extra data. And when I did convert to, I went to open, high, low closes, and then I just went to the close, as this was how all the old, you know, all the golden traders of the past used, just close, sort of bar and the close. And I gave it a go for a couple of weeks, and my trading improved. My analysis and my ability to read a chart quickened. You know, my skill level increased. Again, though, this is just for, you know, it's my personal way to trade them. There's nothing wrong with using an open, high, low close, or candlesticks. Okay, the choice, like I said, is yours. Another question: how to deal with gaps? What do you think? Okay. Good question. Gaps. Very simple answer. It's just merely an imbalance between the forces of demand and supply. So, as you can see down here, when we gap up, that means there's more buying. So demand has entered the market. Now, in this methodology, or any methodology, I would suggest simply draw the tail from the previous bar, and there you have it. You can see that you have an up bar, which just illustrates demand. Nothing simple, you know, no witchcraft. You know, and if we do it here, we can see we gap up, but the close is off the close is now mid bar, which shows some buying as we bought at the lows, but also shows some selling as we sold at the highs. Okay, so that's probably why this market didn't take off. We needed to come back down to test, which we did here. Okay, now I'm glad you brought up gaps. Actually, gaps are very important. Okay, and this is where hopefully during the rest of this course, this session, you realize the importance of structure, and gaps is a way that highlights or illustrates the importance of structure. Why? Well, because I don't know if you noticed, but for those who do trade stocks, okay, it gaps all the time. Well, not all the time, but you know, it gaps over important areas of support and resistance, or trend channels, or apexes, or even some patterns like head and shoulders if you trade them. So what does that mean? Well, what do we gain from that? Well, this tells us that the professionals, you know, the large hedge funds, or the, you know, the well-funded players are aware of these levels. So take this for example. We have support, 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 resistance, resistance, resistance. Okay, now what happens? They gap up over resistance. Why? Well, because they won't want people jumping in with their position. They don't like people jumping on board. Okay, and if you think logically about what's going on here, this is resistance, 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 resistance. There'll be stop orders here, and there'll probably be stop orders here. Okay, as we come, because this is the weak bar. Okay, that we've got selling and selling, we know, because it's closing off the highs. Okay, so stop orders above this high, stop orders above this high. They gap it up. They trigger all those resting orders here, all the sell orders here, all the sell orders here. Okay, all the stops. Then they drive, which pushes up higher. Now this could just be a simple little stop hunt as it closes off the highs. Okay, but they need to come back down and test, which they do successfully here before they drive it up. Okay, so the importance really of structure is that if professionals are aware of these levels, it pays for us to be aware of these levels. And as you go through today's course or today's session on structure, we will see time and time and time again stocks will indeed gap over key structural locations, which tells us again that if the professionals are aware of these levels, we need to be aware of these levels. We need to be able to read these levels. You know, this is why structure is incredibly important, and that it is applied correctly. You know, we want to be or have the same skills or the same chart reading ability as the professionals, the well-funded, the hedge funds. Okay, good question. Okay, is the fourth S a spring? Okay, 1, 2, 3. Oh, I see. Oh, well, it's nice to see you're well versed in this methodology. Well, no. Well, technically, yes, we are springing this local level of support. I mean, drawing supports and resistance. Okay, when you have a gap up, okay, and it's don't forget this is a daily time frame, so it is significant. Daily highs and lows are very important for intraday traders. So when we gap up, when we have a bar like this, we'd automatically draw a line off the top as it closes off the lows and a line of bottom. They kind of form how can I explain this? More often than not, on widespread bars, when they gap up, the market needs time to digest. As you can see here, this is a widespread bar and it gaps up, and we've got. Don't forget, each one of these bars is a day. So this has been going 1, 2, 2, 3. Well, down here it's been trading for a month sideways. Okay, we're unable to break the highs of the original resistance here, and we come back down. So, sorry, to answer your question, yes, we spring this level. Okay, this down here is not a spring. Why? Because we need to dip down. So when we have a support level, this bar here would need to dip down, find no further selling, then reverse to close firm back over support. This here is a test, okay, and it's just testing this support. I mean, this is a Wyckofian setup, which we will go through. It's called the backup to the edge of the creek. So we push up through this resistance level, and then we come back down to test before we rally up, before markup, just to make sure there's no more supply. Okay, so good question. We will go through springs in depth. So, sorry, just to make the point clear, when stocks gap up with a large wide spread like this, it always pays. And I'm sure the volume, we haven't got the volume here, we don't need the volume here, but I'm sure this would be high. Okay, we'd always draw the support from the low of the bar and the top. Why? I know I've said that we draw in the line of the bar so we can see the demand, but don't forget there are many different types of traders in the marketplace, and some traders, they solely focus on trading gaps. Okay, so they'll be aware of this price action. Now, why do I say it's spring here? I mean, this action, this is a 3-bar spring, and if you are springing and looking to buy, okay, it would be this bar on the close around 119. But bear in mind, okay, we successfully test this and we close back over this support, but our first target to overcome will be here. So if we're trading if we're trading 10,000 shares, you want to take off 3,000 or 4,000 at this level. The best little mini spring here really is as we drive up into new highs, we come back down to test newly formed support. Don't forget resistance. As we come back down, should turn to support. So we dip under and then we close firm. You could buy this bar, but we don't have to wait. We don't have to wait for the close. If this dips down and it breaks this high and it breaks this high, you could pull yourself in around the break of this high on an intraday environment, or this high. You don't have to wait until the close, of course, unless you're a position trader. But as we drive up, you can see the spreads of the bars are pretty good. although this looks a bit like absorption, well, we will go into this, we've got rising lows. Sellers are unable to push the market down. And as we break, we get wide spreads. As we come down to test support, look at the spreads. Look how small the spreads are here. Very, very small. That means the quality of selling is very weak. As we come back down, we close firm, we come under, then come down, no real selling pressure in this part, and then reverse right back, and then reverse straight up with evidence of good buying. Good question. Are there any further questions before we move on to the next study? I'll give you a couple of seconds. Okay, let's carry on.